Imagine one afternoon, a sales representative from an insurance company knocks on your door and comes up with a very, very fancy scheme. And he or she starts using a lot of magical words like double income, guaranteed income plan, retirement plan, assured income, money back policy, money guaranteed scheme, etc. What would your expression be? Something like this, or maybe both? Something similar happened to me and my dad. The sales guy comes here. He knows my dad. He knows his history, that dad is very close to the retirement age, that he has a granddaughter who is around age 8. And the sales guy brings up two schemes. Scheme number one: invest 1.5 lakh for the next 10 years, which means that from the age of 8 till the time she turns 18, right, you're investing an amount, a fixed amount, and then granddaughter starts withdrawing almost close to 3 million over the next 10 years. That means from the time she's 18 to the time she's 28, she starts getting a fixed amount that sums up to be close to 3 million. So dad is investing 1.5 million, granddaughter is getting 3 million. It's in absolute terms, this is like 100 double income scheme, and it's fixed income, right? Sounds cool, sounds interesting, right? Dad, he fell for this. Scheme number two, knowing the fact that he's also in his retirement age, the second scheme was more for himself, wherein he had to invest 5 lakh for the next 7 years, which means 3.5 million over the 7 years. And after a pause of 5 years, he starts withdrawing close to 475 or 4.75 lakh for the next 20 years, fixed, guaranteed, which means he was investing 3.5 million, and in return he can withdraw over 9.5 million over the next 20 years, which again in absolute terms, this is 170%. That's like a whoof. And they always end with a magical word: Uncle G, ye sab to tax free hai. This is tax free. Wow, like that's the cherry on the cake, right? Like you're getting a fixed guaranteed income and all of this is tax free. So is there any trap in this? Is this a bad instrument? These schemes are coming from some of the very big insurance brands in the world. In India, you have the HDFC Life Guaranteed Pension Plan, or the Sanjay Plus. You have the Federal Guaranteed Wealth Plan. You have the Kotak Assured Income Plan. Even in Dubai, you have MetLife Retirement Plan, right? So these are brought in by some of the really big insurance players, and it's becoming a lot more common right nowadays. Actually, all of these fall under the endowment policy umbrella. So what is an endowment policy? As per the Wikipedia definition, it's a life insurance contract designed to pay a lump sum after a fixed term or on death, right? So basically it has two components. It has a life insurance component and it has a fixed income component. So basically it's merging, or it's combining the insurance perspective and the return investment perspective into one instrument itself, right? So you're getting the insurance protection cover and you're also getting like a fixed guaranteed income. And the sales team will always use one of these two baits or even both. One is this guaranteed income thing and second is the tax-free income thing. My role from this video is to show you how I evaluated this and how you should be evaluating this. All that you need to know is very basic Excel to put together some numbers and evaluate whether this instrument is making sense to you or not. And again, whether it's the right instrument or not is not an easy question to answer. It depends on your age, it depends on your responsibilities, it depends on your source of income, the future cash flows that you're expecting. That scenario one could be that you're planning for your kids or for your grandkids, so you have a lot of time available for some investment. Scenario two could be like you just got married, starting a family, you want to plan for your kids, right? Or you also want to plan for your retirement, which could be like another 25-30 years down the line. And scenario three is where you're planning for your retirement phase and you're very close to the retirement phase itself. So you have lack of time and you really need like a steady income, right? So maybe you're close to your 50s and you plan to retire by 55, and then you need like a steady income for the next 20-25 years. And now I'm going to take you to Excel and show you how I evaluated scheme one and scheme two. Okay, so scenario one, grandparent gifting their grandkid. Salesperson said invest 150K for the next 10 years. And the granddaughter starts withdrawing close to 3 million over the next 10 years. Scenario two is planning for retirement, where you're investing 500K for the next 7 years, take a break of 5 years, and then from the 12th year onwards, you start withdrawing close to 475,000 rupees for the next 20 years, which then, based on the absolute term, is a return of 171%. So let's take this one by one. 8, which is today or this year, my dad has to invest 150,000. So whatever is the amount to be invested is in negative. This is the outflow. And then whatever is in positive means the inflow, right? This is if there's any bonus involved. And this basically then the total amount, net amount that's going in or out. So year one, At the age of 8, basically, my dad is investing 150 for the next 10 years, which sums out to be 1.5 million. So until 2032, there's only an outflow. Starting 2033, when she turns 18, she starts getting a fixed income. So year one, she gets 55,000, then 58,000, then 61,000, then 64,000. In year five, she's getting 68,000 plus a bonus of 882,000, which sums out to be 950,000. Then year six is 75,000, 74,000, 78,000, 81,000. And in year 10, again, she withdraws 84,000 plus a bonus of 1.4 million. That sums out to be 1.5 million. So in total, my dad invested 1.5 million over the 10 years. And over the next 10 years, she withdraws almost 3.017 million rupees, which, if I were to do the basic math or the absolute math, would come out to be 100%. But what we completely forget is this is over how many years? This is over 20 years. So from 2023 to 2042, which is over 20 years, as a fixed income, she's withdrawing 3 million. I'm going to use a very basic formula, the rate of return, which is also the IRR, the internal rate of return. This gives you a flavor of the year over year investment return on this instrument, which only comes out to be 5.9%, meaning that this instrument is actually not even beating the inflation rate. And because you're actually making a loss, this can be considered as a tax-free instrument because there's no indexation applied on this scenario. If I just look into the absolute terms of putting in 1.5 million and getting back 3 million, it might seem like a big investment opportunity, but the rate of return actually is just 5.9%. I will not say that this is a bad idea. If I factor in the emotional perspective of a grandfather or a grandmother, or an emotional perspective of planning or gifting something to your loved dear ones, right? This may be a good idea, right? So all that I wanted to show you is like, do this basic math, just prepare this simple table, whatever scheme the sales team, comes up with, just put this in one order, list them down. All that you have to do is then select that whole, period and use the IRR formula to calculate the rate of return, which will be the actual rate of return for the instrument. Now let's evaluate scheme number 2. Scheme number 2, planning for your retirement phase, right? So let's say you're close to your retirement phase. You may be still earning some salary, but you know that maybe after another 5-10 years, you will not be having a steady income. So a natural lookout for you would be to find an opportunity or an instrument that gives you a guaranteed fixed income over the next 20-30 years. And that's what scheme number 2 was proposed to my father. Now in this scenario, just to reiterate, you're going to invest 3.5 million. You're going to get 9.5 million over the next 20 years, which in absolute terms comes out to be 171,000. Let's do the math again. There's different versions of how the inflow and outflow can be for each plan. So you just have to do the same math, put them all year over year by year in one single column and apply the IRR ratio. So what was proposed in this scenario was age 45. Let's say you're close to age 45, right? Close to age 45, this is 2023, you start investing 5 lakh rupees or 500,000 rupees for the next 7 years. So 1, 2, 3, 4, 5, 6, 7. So for the first 7 years, that is until 2029, my dad has to invest 3.5, which closes down to 3.5 million. That's this. Then for the next 5 years, he will not be putting any money in, neither will be getting any money into his account. So the next 5 years is blank. Nothing happens there. But the insurance cover is still active during that period, right? And starting the 12th year, that is from 2035, he can withdraw like a fixed income of 481,000 rupees for the next 20 years. That's until 2054, which sums out to be 9.637 million. So in absolute terms, though it was 171,000, we have completely forgotten that this is over 32 years. The whole exercise or the whole scheme took 32 years, which is why if I calculate the internal rate of return, the actual investment return is again coming close to 5.9%, which again will not beat the inflation. However, here the emotional angle of this is like, maybe you may still prefer or go for this because you're close to your retirement age. You really need this steady income of 481,000 for the next 20 years, which might appeal to a lot of our parents or a lot of us who are in that phase. So in summary, endowment policy can come to you under different names by different brands. It can be called a fixed income, guaranteed income, money back, but it will always have a life insurance component. It will always have a fixed income guaranteed plan, and they will always use this tax-free based on your age, based on your risk appetite, based on multiple other factors, personal factors. The scheme could be a good instrument for you or may not be. Maybe it's worth exploring the equity option if there is more time involved and there is, a room for risk to average out, right? Especially for scenario number one, where it might be for your kid, grandkid, there's at least 25, 30 years of, time available. You might want to not go for this instrument, but rather go for something more on equity side, which has more risk, but more reward, right? But maybe if you're in the scenario 3 bucket, wherein you're very close to your retirement phase and you would prefer something like a fixed steady income, you may want to consider this instrument, because this guarantees you like a steady income without much risk, and you have the tax benefit. Hope you like this video. Like this video, share this video, and subscribe to my channel. Thank you.